Welcome, everyone. Welcome to the Hurley Investments market view commentary for Monday, the 23rd of September. We'll have one more next Monday, and it'll basically be the end of the month for us. Lee, glad you're here. Glad things are working for you. William, good to have you here. It's been a while. Mary, always nice to have you. I see Kohler. Bruce, we've got Bruce in with us today. Bruce, I think this might be a first time for you. Bruce, if this is the first time, go to the questions or the chat tab. You got it. You figured out how to do it. Bruce, welcome to our group. Glad to have you guys here. Bruce is a new one with us as well. So, Bruce, hopefully I'll have some good information here for you. Bruce says it's the third time. Well, it's probably the first time I'm introducing you, Bruce. Sometimes I get 40, 50 people that come in and I just miss them as they're coming in. Glad to have you, though. And Bruce, we just had William that said welcome to you, and Mary that says, Bruce, welcome to our group. So we've got two that are welcoming you. All right, here we go. To get started today, I've got two thought processes in mind. Let's start off first, though, with what are the expectations for the market? Boy, I just can't spell. Now that we know we have a 1% total decrease in the FOMC, I should say rate path, and another 1% drop next year as well. So here's my question. What is the expectation now for our stock market? I want you to internalize this. If we're going to get a couple drops in rates, what does that mean? What's it going to do to our stock market? What will it do for you? Give me some ideas of what this rate cut is going to do for us, for you in general. What are the thoughts behind what we can do? So, supposed to be higher, but I don't trust it. Give me a reason why the stock market would be higher with a rate cut. Let's put our reasons. We're going to do some reasoning today. So reasoning on what this all means. So Abraham says, in theory, stocks will go up, but many other factors can affect wars, elections, Mars. So that, I like both of these. Let's go through some of these because this is interesting. It should mean better earnings for small caps if they haven't really taken off, or any variable rate fixed cost companies. If anyone is borrowing, it's going to help that company. Now, interesting, someone said easier to borrow money. It doesn't make it easier to borrow money, but it's cheaper to borrow money. And I guess where I would look at that, if I'm going to change both these. I would look at it more in housing, credit card rates, and materials. If you're going to buy something to make something, it's going to be cheaper. So that's where everything all comes together. All right, I got someone texting it in. Someone tell me, why would we expect our stock market to go higher? Because the honest truth is, if housing is going to be cheaper and credit cards are going to be cheaper, that's usually the bank that'll lose that money, right? Tighter spreads again, less they can make. I love that one. So great idea. And I'm going to type it all in. If somehow the Fed is not going to diminish liquidity, strange effects might happen. Yeah. By dropping so much, it's like they overshot the mark, right? By dropping the rate so much, they've overshot the mark. So the question is, has that really constrained the growth in our economy? Has a 5% interest rate constrained the growth in our economy? And the answer is, well, yes, it's slowed down the housing market. People weren't looking to get into a home as they've drunken the Kool-Aid for 10 to 12 years with zero interest rates. All of a sudden, home prices became unaffordable for beginner home buyers. I'll be the first one to say my kids are looking at me like, Dad, how the hell am I ever going to afford a house? I don't have an answer, but again, it's going to be something simple. You're going to get a house, a beginner house in the outskirts. It's not going to be what you grew up with. And it'll appreciate, and you'll sell, and you'll put that into another house, and you'll be making more money. And you continue, or I guess it's a progression or a plan of progression to get to where you want to be. We're talking about strange effects, right? There are some strange effects that we're facing in today's market. Can someone tell me what's the most important upcoming event? And then for the for the rest of this year, right? What is the most important event affecting the stock market? Anyone know? You guys got it. All four of you, all five of you. It's the election. We don't know where our country's going to go until we know who's running it and what ideas they're trying to push. I think for the most part, the election can be broken down into two different ways. If you're a Democrat, what are you guys pushing? And for Republicans, what are you guys pushing? Give me an idea. What are you guys pushing for the platforms? So it's interesting. The Republicans was just typed in tariffs, which equal higher taxes. And knowing you, William, I'm going to probably say that you're more of a Democrat, that you're pushing that as the Republicans. And in theory, you're right. If you put tariffs, someone's going to have to pay for that. And it's not higher taxes, it creates higher prices. But with that said, does anyone feel that that happened when we put the tariffs on China for their cars? Did anyone see higher prices from the tariffs that we put on China, especially the cars? So as a Republican, it's kind of funny because I hate to put that down, but technically you're right, William, 100%. Tariffs are supposed to equal higher prices. And I would say that that is definitely a Republican platform that they're running on. But it's kind of interesting because things that happen in theory don't happen in real life. I'm sure you can come back and you can tell me, well, prices went through the roof under Trump, which yes, they did. Plywood costing $86 a sheet was ridiculous, but I might consider that a COVID issue versus maybe a Trump issue. I also want to say that was maybe worse under Biden, but it got better. But I don't think COVID is a Democrat or a Republican platform. That was a pandemic. And I'm not going to assign, I don't think it's right that you would assign blame to either party for a pandemic. Just my two thoughts there. Okay, here we go. Debt reduction. That's funny because both of them are pushing debt reduction, right? And to a certain degree, I think Trump was on a great path of doing that until COVID. And to give Biden credit, the deficit was shrinking under Biden too. So I think you got to give, again, both parties, unless you want to assign COVID to a party. And I don't think it's fair to assign COVID to either party, to be honest with you. I'd agree with that one. They want to do lower taxes here, and I agree that Democrats want higher taxes. These are the kind of things that you're going to be looking at for hopefully who you vote for. And I will go so far as to say this. Again, I think it's really hard to like either person as a person. It's I don't think it's about the person you're voting for, a platform. China can afford the tariffs to a certain extent. I agree. Quite low options trade day, which suggests people with great doubts where things will go. Yeah, I mean, it's really, we have a lot of uncertainty. And unfortunately, I think the uncertainty is on both sides. And we did see what Trump did the first time around, but again, I think he's pissed. And I don't think a pissed off Trump is the best way to go sometimes. I like when he thinks rationally when a camera's on him, where he's got to behave. All right, so here's the short answer. Yes. we are facing uncertainties. But that's why the, can't type today, protective put is so important. Anything you make up on the way down can become more shares or be profit as things come back up. Lowers your break-even point. Now, a couple of you said, Kevin, I don't understand the stock replacement strategies. And so I'm going to bring them in on Meta. Some of you have asked me this recently, and I want to show you or bring you in so that you understand the positions. And let me find my other one. Get the titles for you. Okay. So here we go. In some accounts, you're going to notice where we have what is called an option spread. And this one, we have a June 25, 470 and a June 25, 540. It looks like this. We have the right to buy Meta at $470. That right cost us $80. What we spent $80 for, we are up roughly $50 on that position. But because we were uncertain, because we did not know, we created a position at the top that caps us a short call where we had the obligation to sell at 540. Someone paid us $54.60. Here is the short answer. And this is where it all comes to an understanding. What is the difference in the two strike prices? Have the right to buy at 470, obligated to sell at 570. What is that difference between those two strike prices? Someone type it in, someone let me know. What is the difference between those two strike prices? I don't see anyone typing anything in. If you type 540, right? That's where you're going to sell. If you buy it at 470, buy at 470, sell at 540, that's $70 of profit. We paid $28. I'm going to round. We paid $29 to get in the position. The basic idea behind this, we paid $70 to try to make, excuse me, we paid $29 to make 41. Our goal is to exit this position when each contract is worth roughly $70. That will most likely come sometime in June. $41 profit, the short answer, you take $41, divide it by 29, your cost basis. We're looking to make roughly 141% return on invested capital. We have another one down here, a 520 600. If we do the same math to these positions, we're trying to make here in in January of 2025, we're trying to make $80. We spent 32. Take out the 32. We spent $32 to try to make 48, which is a 150% return. Meta should top out at about $616 this year. That was the low end target price. 653 is the high end. It'll be pretty neat because we have 3 contracts here. These 3 contracts are only worth 9,600. We're looking to exit those when they're worth about 24,000. These contracts right now are worth 2,881 right here. We're looking to exit that when that is worth $4,000. That's what we're trying to do in these stock replacement strategies. For those of you who are wondering, Kevin, what are you doing? Well, last year, Meta wasn't supposed to get above 500, and it had a hard time doing it, so we sold out of shares of Meta at 500. Some of you booked a great profit. Others of you, we had stock replacement strategies in place, and we got rid of those lower stock replacement strategies at the end of last year. These are the newer ones that we got in. When we sold the shares of stock, we did the 520 600s, so that you still had the opportunity from about 510 to 600 to make some money. For those of you that did not own shares of Meta, we were in the 470 540 group. And again, there have been previous ones. We've had these in for a while. But the 544, the 470 540 ones, I think we put those in February or March of this year. The Meta ones, the 520 600s, we put those ones in January. Last year we closed out 250 300s, 300s 350s, 350 420s, 360 420s, 350 450s. We had a bunch of these staggered through people's accounts to try to make a killing on Meta, and we did really good. We're going to have some talks with some of you come the end of the year, because taxes on Meta might be through the roof. So we might have to take a 30-day loss on a Baidu or a Disney to offset those capital gain profits you have in Meta. But that's what these positions mean. If you have any questions on these, please zip me an email and I'll give you a call and we'll go through your own portfolios to see what you have and where you're at. The briefing. It's kind of interesting because everyone's talking about the federal funds rates, where we're going to go. It's really, I don't know. I want to say it's just surprising, because now that that's out of the way and we feel inflation is out of the way, it's going to come back down to, hey, what are the earnings going to be and what will the election be? That's what we're trying to figure out right now. Can we keep growing at the rate that we thought we were growing? It'll be interesting because we have Micron that reports on Wednesday after the market closes. If you ask me where we're going, I'm going to say higher. Our charts show basically the same thing. We're really close in the upper right-hand corner of this chart of being overbought again. Last time we were overbought, pretty big drop down. We went from 41.4 down to 38.5. It was a good pullback. Kevin, does it always do that? Well, it kind of did it before, right? Right here. 39 down to 37.6. We had one right here, 40,100 down to 38. So if you do the math, 2%, 3%, 5% drops, they happen on the Dow. Probably need to be ready for it coming up to our next earnings season. S&P 500 looks much the same. I would give you the same warning. Last time we were overbought, 10% drop. 5,669 down to 51.19. 10% drop right there. 52.64 down to 49.53. About a 6% drop right there. Kevin, the S&P is different. Correct. We built a base in June. We built a base in May. Does it mean if we hit overbought, we're going to go down? No. But that is the expectation. That's how charting works. That's where we need to look at this and say, hey, it's not always accurate, but the social science gives us an idea where stocks can head down to. And I was just looking at that. If we lost 10%, we're sitting at 5,733, going down to 5,200. That would be a pretty realistic expectation. That's where our S&P 500 stock and index could go. No questions asked there. Past performance does not guarantee future results, but that is just something to understand. And then we're looking at the NASDAQ. NASDAQ is not in quite the same dire straits, but if you take a look at its past performance, overbought 18,671 all the way down to 15,700, about a 15% drop. Yes, overbought here, little 2% drop. It looks a little different. It actually built a base in May as well. Short answer, we're probably news driven. We're election news driven for the next little while. We will go through earnings the middle of October through the middle of November. All right, here we go. Where were the S&P in October? I'm saying down 2.5%. I'm saying that because normally October is a really poor month, but I do not have, I don't have an understanding. I'll be honest with you. I'm not sure where we're going to go. I'm following the trend, and we're really quickly looking to put protection on where needed. Some of you have said, well, Kevin, you don't have protection on Micron, and it has its earnings coming up in 2 days. Correct, and it's run about 10%. So we're going to put protection on 6 weeks out in time and do the best we can to really try to catch if we have to tomorrow. I'd love to protect it up at 100. What an amazing price that would be to be able to protect Micron at 100 before earnings and then see it run back up to 125 or higher towards the end of the year. That would be awesome. But it's been coming up from 88 up to 94. I think it finished above 94, 94. 93.57 is where it finished today, coming up from 88. So it's been up $5.50 roughly in the last week, which again is about 6.5%, 7%. And after hours, it looks like Micron's up another 48 cents, breaking the $94.05 mark. That's kind of nice to see. All right, earnings. AutoZone, KB Homes on Tuesday, Fuller Homes, Micron on Wednesday, CarMax, JBL, BlackBerry, Vail, and Costco on Thursday. Economic reports were just loaded up for Thursday. We do have housing indexes on Tuesday with consumer confidence. Wednesday, we have new home sales. Thursday, durable goods and GDP, pending home sales. It's a big day. Friday, personal income, personal spending. Not quite as big as Thursday, but good GDP numbers. We're off to the races. As I've been looking at what can happen, I'm giving you guys information. The big post-Fed rally could get tested a week ahead. A lot of holds in the balance of the next few days. I'm giving you information on where people thinking we can have some potholes and what's going on. This is where you need to read through this, because you'll sit there and you'll go, for crying out loud, no one knows a bargain thing. And the answer is correct. No one really knows. Very interesting from Gorman. They're talking about using options to hedge volatility, to buy a call on the VIX, where if it goes higher, as things get convoluted, you make money on it. Very interesting strategy that now we're getting the use of options into people's portfolios. A more positive, hey, the Fed finally cuts rates, what the stock market historically does from here. Overall, the broader index was higher 70% of the time, 3 and 6 months out, and 80% of the time 1 year later. That's the short and the skinny. If you go all the way back to 1970, the last 54 years. Could there be other years? Yes. But here is what history is. If you want to know the history of rate cuts and the histories of recessions, here's the article for you to go over and to understand what we have coming up. I thought this was funny that someone came out here on the CNBC Pro. These are the stocks that do best immediately after the first Fed rate cut of a cycle. Western Digital, technology. Lam Research, technology. United Health Group, a healthcare. Expeditors and National Washington Inc., industrials. Apple for technology. Kroger for consumer non-cyclicals. Textron for industrials. Franklin Resources for financial. Amgen for healthcare. Target Corporation for consumer non-cyclicals. I'd say consumer discretionary is the better way to say both those. Well, yeah, we've hit 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6. 6 of the 11 sectors. What a useless article telling us that, hey, certain things in certain areas go up. Duh. We should know that. Last but not least, I found an interesting article on NVIDIA versus Alphabet, as they tell you which one is best if you want to go to Google or NVIDIA. Well, it's kind of funny because the article says both. You should go to both. They're both going to be winners. And our last article here tonight, Deutsche Bank says these two high yield dividend stocks, including one that gives a 13% yield. The whole idea is now is the time that if you want to see some growth in bonds, you get that growth in bonds as rate cuts happen. Great time to own some 10-year treasuries. They'll become more valuable. You'll be able to sell them for a premium. Now's the time that you should have already locked in. If you're looking at bank CDs, you should have locked them in about 3 weeks ago, a couple weeks before the rate hike. That would have given you your best interest rate for the following 6 months to 2 years on a short-term CD. All right, questions. What questions do you guys have that I can try to answer for you? Understanding that, yes, we're probably going to go through some swings in our markets for the next 6 weeks, all through October, the week leading up to the election in November, and the final week in the sale. It would not surprise me to see our markets maybe towards the end of this week or on Monday as we finish our quarter for the S&P 500. September will finish off the yearly quarter. We could see some selling again as people take profits because of the uncertainty in the November election. So short answer is we're probably going to be adding protection going into this week to protect you not only through a sell-off at the end of a quarter here in September, but to get ready for protecting you at a higher price than where we think stocks are going to be for their earnings reports coming out in October. With that said, what questions do you guys have for me that I can answer? Or that I can try to answer, right? Abraham, a lot of those trades, again, were old. We went into most of those January and February of this year. In fact, if you guys go back to the My Hurley Investments, you can track those back in January and February of this year. All right, any questions you guys have that I can answer for you? The short answer is there's uncertainty. We don't know where the market's going to go, but we have some seasonal trends. October is usually a down month, one, because we have the end of the September quarter. Two, because the blackout period extends longer during that month. Because the quarter ends there in September, usually you have a couple weeks, somewhere between 2 to 4 of a blackout period before and after the end of a quarter so that you can't boost up the index the last couple days. And then you got the blackout periods for companies the 2 weeks before they have their earnings reports. So the reason why October is usually such a poor month, big quarter finishes in the S&P, and it ends in the end of September. That extends the blackout period for week before, week after, and then blackout periods for earnings that are coming up for companies, especially through that October month. So typically you get no companies buying a bunch of their stock back through that month of October. You have to wait for 48 hours after the earnings event. In fact, would you guys like me to find some information for you guys on what the blackout period is and what it means so you can start to understand that better? Is that something that you guys would feel helpful for, or is it pretty self-explanatory? Or am I just putting you guys all to sleep today? Who knows what's going on? All right, well, I don't see anything. So, guys, have a wonderful evening. Appreciate you being here with us today. And I'm trying to delay to see. All right, guys. Hey, you guys have a great evening. We'll get this posted tomorrow morning sometime. So it should be available for you by Tuesday afternoon. Have a good evening, guys. Pleasure being here with you. Bruce, glad to have you with us, and I look forward to talking to you guys next week. Good night, everyone.